due to hit over 31 degrees today. So it's great to be alive and well in Johannesburg. And today's presentation is from Zeridium by David Grenville and Anthony Chait. And welcome everybody. If you haven't got your notes, just put a note in the chat or the Q&A, and Danny will send you the link. This is being recorded, so anybody who misses anything or wants to have a look at it will be available. Your certificates will be sent out following this, probably the next day or so. You should get them by the weekend. And I'm going to hand over to Anthony Chait to introduce the topic, and then David Grenville will take it away, and I'll go back to Danny, my feet in the pool.
Right, thank you, Stan, for that welcome. And this is the first part of two series of courses that we are presenting, proud to present in conjunction with CPD courses. Today, which is on the topic of loop structures, and then in 2 weeks' time, on the 28th, you would have noticed on the...
is it not next week?
Is it next week? Okay, 21st. Thank you, Danny. Next week, same time, on the 21st, the topic is going to be financial immigration, and if you blinked, it's now called tax immigration since the 1st of March, and that'll be handled by another one of our colleagues, Robert Verkale. So just to introduce today's presenter, David Grenville. He's a BA, he's got an LLB cum laude and an MCom with a distinction, and his tax thesis was voted one of the best in the country. David's been part of our team for just on 5 years, and when he's not figuring out loop structures, he's also busy with foreign structures and handling disputes with SARS in terms of the legal process. So just before handing over to David, a little bit of introduction to loop structures and how they've evolved literally over the past 20 years or so. And just prior to the first and major tax and exchange control amnesty that took place in 2003, those of you who might recall and perhaps were involved in some applications, there were 45,000 applications received by the amnesty unit at the time. And our firm handled a number of them, and we found in the course of preparing those applications that there were people were trying to regularize a foreign structure, for example, a trust, which had as its investments, as opposed to foreign investments or foreign assets, there were investments back into South Africa. And I remember one day having a chat at the amnesty unit with one of the Reserve Bank guys, and I said, you know, this is interesting. How do we calculate the 10% levy that you guys are going to charge for regularizing foreign assets, when in fact, if you look at the looped asset, it's actually in South Africa. That's not foreign at all. Would you still be charging the 10% levy? And that seemed to set the cat amongst the pigeons. The Reserve Bank had a look at it in 2 circulars almost 18 years ago, in 2003, the famous D405, and later I think it was called D417. They actually outlawed loop structures, and they warned the public that anyone who had been involved in a loop structure had to regularize it with the Reserve Bank. There were certain levies in the way of penalties that were charged. And there were many of them out there, as I recall, because prior to that, some of my colleagues had been marketing these so-called 7426 structures, which was in fact just a loop structure where your foreign trust held 74% of the shares, and then you in South Africa held the 26%. And needless to say, the Reserve Bank became unhappy about that. They outlawed it and gave people an opportunity to regularize it as part of the amnesty process. And therefore, in the past 20 odd years or so, we've spent a lot of our time just regularizing old loop structures. And it seems that the wheel has turned a full circle, because from the beginning of this year, loop structures were now condoned, were acceptable. Obviously, one needs to apply. David will give you all the details in a very animated sort of way. So, and I should say that David, in fact, when the new dispensation came in, wherein loop structures were completely legal, David was one of the first to get his particular application over the line in very early January. So without any further ado, let me hand you over to David. I'll be remaining here in the basement in the control room, and any questions that arise, rather than using the chat, if you look at the bottom of your screen, there's a Q&A box. Just pop your questions into the Q&A. I'll monitor them throughout, and we'll deal with them gladly at the end of David's presentation. So, David, over to you.
Excellent. Thank you very much, Anthony. And thank you both Stan and Danny for giving me the opportunity to present with you today. I think this is a very interesting topic, and quite advantageous that we're dealing with it now. There are a number of interesting developments underway. All right, so as Anthony said during my presentation, if you do have any questions, pop them into the Q&A. I understand that Anthony will monitor them. For the most part, I think this presentation should take us to just before 2 o'clock, depending on how inundated you are with questions. From 2, we'll then give you some dedicated Q&A time where Anthony and I will do our best to answer as many questions as we can, viewers. All right, so if I can turn your attention to the visual presentation. In this seminar, obviously we're going to be talking about loop structures, and I'll be providing a broad overview of the South African principally exchange control landscape in relation to loop structures. It's my goal that after this presentation, you should have an understanding of what constitutes a loop. You'll be able to identify loop structures in a variety of different situations. You'll be able to understand why loop structures were prohibited in the first place, and more importantly, why that prohibition was relaxed. I will provide to you a broad outline of the technical requirements for the creation of a loop structure, and that involves the reasons for wanting to create a loop structure. And then finally, as an added bonus, I will give you an overview of some of the key tax concepts that should be applied to loop structures. All right, so without further ado, let's dive into the first question, that being, what is a loop structure? Now, the definition that you might have heard from time to time is that a loop structure is a foreign structure in which a South African resident has an interest, which reinvests back into South Africa. Don't worry if this is a bit of a mouthful. We will go through each element of this in minute detail as I go through the presentation, and I think by the end of it, you'll have a good sense of what this means and how it works. The reason for the historical prohibition of loop structures is that they give rise to the possibility of a contravention of Regulation 10(1)(c). That's the regulations promulgated in terms of Section 9 of the Currency and Exchanges Act. In other words, the exchange control regulations. Regulation 10(1)(c) states that no person shall, except with the permission granted by Treasury, and in accordance with such conditions as Treasury may impose, enter into any transaction whereby capital or any right to capital is directly or indirectly exported from the Republic. Now, this provision we'll revisit a number of occasions throughout this presentation, so don't worry too much if it's a bit of a mouthful. In short, however, Regulation 10.1c works within the entire framework of exchange controls to ensure that no assets or rights to assets flow out of South Africa except with prior approval of the authorities. So on that note, it's worth doing a quick aside. Who are the authorities that we're talking about here? Principally, it's the National Treasury, of course, the South African Reserve Bank, and the authorized dealers. For those of you who aren't familiar with exchange control, the authorized dealers are the various commercial banks authorized by the Reserve Bank to deal in foreign exchange. All right, so in order to understand what a loop structure is, we first have to put on our exchange control hats. And for those of you who have done that in the past, it involves drawing the ocean. I recognize that most of my audience here today are probably of the accounting persuasion. And so when you draw your ocean, it probably looks something a bit more like this. Everything below the line representing South Africa, and everything above the line is, of course, abroad. Now, that said, a loop structure is a foreign structure in which South African residents have an interest which reinvests back into South Africa. From this, we can discern three components. There is the South African resident, there is the foreign structure, and the South African investment, or the reinvestment back into South Africa. These components obviously give rise to two legs. There is an outward investment leg and corresponding inward investment leg. It is a second leg, the inward leg, that gives rise to the Regulation 10.1c contravention. This inward leg gives the opportunity for assets in the form of dividends, rental income, or even just capital appreciation to flow to the non-resident. However, the key here is that non-resident is not a non-resident proper. It is ultimately for the benefit of a South African resident. And that's what gives rise to the loop structure, because you've given a South African an opportunity to externalize assets without going through the ordinary authorized channels. If for a moment we ignore the South African resident, then we can quickly see that the loop structure falls away. Non-residents proper are permitted to invest into South Africa, and if I understand our president correctly, these investments are actually even encouraged. So it's only by having all three components in place that a loop structure arises. That being said, if you've ever dealt with a loop structure in the past, you will recognize that there is a high degree of variability that can potentially disguise a loop structure and its existence. So in the interest of giving you a full idea of how loop structures exist and how they work, let's take a dive into each of these three components to understand the variability. In the first instance, there is the South African resident. Now, it's important to understand that I'm using the term South Africa as shorthand for the common monetary area, often referred to in exchange control parlance as the CMA. And the CMA consists of South Africa, Namibia, Eswatini, and Lesotho. Now, when we talk about a resident, this can be any type of person. Coming from the legal background, we're taught that there are two types of persons. There are natural persons, being individuals, and there are juristic persons, principally in the form of companies or corporations. All right, so for the most part, we're talking about persons proper. That does not involve a trust. Not only is a trust not a person, but in this situation, a trust isn't part of the exchange control framework for loops, because trusts are, for the most part, not permitted to own or have an interest in foreign assets. That being said, there are some rare exceptions where local trusts have been granted permission to obtain foreign assets, but for the present purposes and for ease and simplicity, let's ignore local trusts. All right, so what then is a resident? the Currency and Exchanges Manual for Authorized Dealers. This is the document in which the Reserve Bank created the exchange control policy, and I'll refer to this document throughout the presentation as simply the manual. The manual defines a resident as any person who has taken up permanent residence, is domiciled or registered in South Africa. Correspondingly, a non-resident is a person whose normal place of residence, domicile, or registration is outside of the CMA, outside of the common monetary area. Now, unfortunately, these two definitions don't give us very much to work on. The phrase permanent residence isn't defined, domiciled is not defined. The only thing we have to go on is registered, and if your company is registered here, then it's quite easy to understand where its residence is. So this concept of residence is, as Anthony mentioned at the outset, currently the subject of significant uncertainty since on 1 March 2021, 1 March this year, the definition of exchange control resident was largely discontinued with the removal of the financial integration process. Fortunately for all of us, and in particular, fortunately for me, my colleague Robert Verkale will be doing a seminar on this concept exactly this time next week, so make sure to tune in for that one. All right, so we've dealt with the first aspect of a loop being the South African, or more specifically, the CMA resident component. Let's now look at the second component of the loop structure, which is the foreign structure. Now, in order to fund the foreign structure, South African residents should have authorized foreign assets. These are assets which are held by South Africans offshore in a manner that is compliant with the South African exchange control regulations. As an individual, as a natural person, there are several different ways to obtain authorized foreign assets. First and foremost, you can use your single discretionary allowance. This is an annual allowance that is applicable to each natural person. Currently, it's 1 million rand per year. In particular, when we're talking about the allowances, don't get tripped up there. It's quite tempting to think about this as the normal financial year, March to February. However, your single discretionary allowance is a calendar year allowance and therefore runs January to December. So at the beginning of every year, every natural person gets 1 million rand to play with offshore. The second way to have offshore assets is by using your foreign investment allowance. This is currently 10 million rand per natural person per year, provided you are an adult. Another way to obtain foreign assets in an authorized manner is by way of a foreign inheritance. Be aware that it requires a foreign inheritance in order to be authorized needs to have been from a non-resident, and the inheritance needs to have taken place after the 17th of March, 1998. The next category of authorized foreign assets is typically foreign earned income, provided that the income was generated by you while you were physically abroad and after 1 July 1997. There are a host of other types of authorized foreign assets or methods of obtaining authorized foreign assets. I won't go into many of those now. One that springs to mind is if you've used one of the amnesties to regularize foreign assets, they'll be considered authorized. And just so that you're aware, regularized foreign assets have been tested as part of the loop structure. And as far as the authorized dealers and the Reserve Bank are concerned, if you've made use of an amnesty, it's as good as if you had used one of the other allowances to externalize your funds. All right, so as you can see, as an individual, there are multiple ways of externalizing assets in compliance with the exchange control regulations. If you are a company, on the other hand, there is only one method, and that is by using the foreign direct investment regime. For the most part, this is 1 billion rand per company per year. So provided you make sure you obtain your FDI in an authorized fashion, I don't think that many companies will be hitting that ceiling all too quickly. All right, so we now know that we've got a foreign structure that's funded in an authorized manner. In other words, the South African residents behind that structure have externalized or obtained foreign assets in an authorized manner. We now need to understand what could the foreign structure consist of. Typically, it's in the form of either a foreign company or a foreign trust. There are some very interesting vehicles like foundations that people use from time to time, but South Africans tend to use foreign companies and trusts. Alternatively, there are a number of very complicated structures which involve various combinations of companies and trusts. The bottom line is, provided your foreign structure is funded in an authorized manner, no matter how it's constructed, it will be authorized from an exchange control point of view. All right, so zooming out, we've now clearly dealt with the South African resident component and the foreign structure. The third component, very clearly, is the reinvestment back into South Africa. Strictly speaking, this reinvestment will take one of two forms. It's either an investment to acquire fixed property situated in South Africa, or shares in a company which is situated in South Africa. Again, bear in mind the definition of a resident. For a company, this is a company that's registered in South Africa. And so any registered South African company, whether it's listed or private, will be regarded as a South African company for the purposes of the reinvestment. I said that these are the two principal ways. Given that loans give rise to the propensity or the ability to externalize interest, they're typically also referred to as giving rise to a loop structure, although not strictly speaking a loop proper, because they don't represent a reinvestment. I would classify them as part of your loop thinking if you are wanting to know whether or not you've got any concerns with the exchange control authorities. Again, for the avoidance of any doubt, when I refer to South Africa, I'm actually referring to the Common Monetary Area countries rather. And so any investment, whether it's fixed property in Namibia or shares in a company in Lesotho, that will be equally considered a reinvestment giving rise to a loop. All right, so if you have all of these three components, you have yourself a loop structure, and from up until rather the 1st of January this year, you also have yourself a problem with the South African Reserve Bank. Now, the reason that problem arose is because your reinvestment gives rise to the possibility to externalize rental income in the case of property, dividends in the case of shares, capital accumulation in the case of either, interest in the case of loans. And it's this externalization of assets that gives rise, again, to the Regulation 10(1)(c) contravention and to the loop problem, because the Reserve Bank can't adequately constrain this outward flow of funds. It's worth mentioning at this stage that some of our clients in the past have obtained or thought about loop structures in a rather interesting way. Given that the 10(1)(c) contravention is a problem, what happens if they undertake not to externalize rent, dividends, capital, or interest? What happens if they have what has been colloquially referred to as a toothless loop? Well, unfortunately for those individuals, the Reserve Bank aren't just concerned about whether or not you actually externalize assets by way of the loop. It's the propensity or the possibility, the legal right to externalize assets that gives rise to the problem. And in particular, when a foreign structure acquires South African assets, as you might know, those assets are often endorsed or held by the authorized dealer on your behalf. So in the classic example of an acquisition of shares in a South African company, whether you're acquiring those shares by way of a share purchase agreement or a subscription for shares, those shares will ultimately be endorsed to non-resident, and that endorsement gives rise to the right to have any dividends externalized from South Africa. Alternatively, in the event that you sell those shares, the proceeds should be able to go offshore without restriction. So unfortunately, the Reserve Bank was not persuaded by our clients' undertakings to not trigger the loop and instead to have toothless loops in place. All right, so in order to understand where we are today, we need to understand the current regime in the context of how we got here. Importantly, we need to understand the thinking behind the relaxation of the prohibition of loop structures. And this will enable you to determine whether you are on the straight and narrow or whether you might be straying into some challenging territory. So how did we get here? The first mention of the total loop relaxation took place in February 2020 by the then Minister of Finance, Mr. Tito Mboweni, when in the full text to the budget review document, it was stated that loop structures could more appropriately be dealt with through tax legislation than exchange control. In particular, the budget review document identified potential tax leakages and stated that exchange control was not the right mechanism to combat that potential tax leakage. I perfectly agree with that sentiment. Following from that thinking, in July 2020, the explanatory memorandum to the draft tax law amendment bill was published. And in that document, it was stated that government would be moving towards a new capital flow management framework. What this means is still to be understood, but the capital flow management framework would be aimed at promoting investment into South Africa and reducing unnecessary Reserve Bank approvals. A laudable result. Definitely the Reserve Bank are inundated with applications at the moment, and any manner in which the regulatory burden can be shifted away from the Reserve Bank will obviously be better for both the authorities and for us trying to get a seamless exchange control mechanism. Importantly, the new relaxation would be a relaxation of the loop policy, and with that, various tax amendments were proposed. These tax amendments were principally aimed at the conduit principle and Section 25B of the Income Tax Act. I'll deal with the tax consequences of loops a little bit later, but for the time being, it might be worth noting that the provisions relating to loops, in particular the participation exemption for holding of companies, had some limitations placed on its application to ensure that loop structures can't be used to obtain unnecessary tax advantages over non-loop structures. It might be interesting for you to note that although the TLAB was published in July, it went through its normal process of obtaining public comment and was ultimately enacted at the end of 2020 with effect, or at least the changes in relation to loop structures took effect from the 1st of January this year, 1st of January 2021. All right, the next mention of loop structures took place in October 2020, when in the speech, the medium-term budget speech that is, Minister Tito Mboweni again confirmed that the prohibition of loop structures would be relaxed to make cross-border business easier. And by that point, it was clear to us that loop structures were going to be a thing of the past. And the final step was in January 2021, when the Reserve Bank issued Circular 1 of 2021. This circular ultimately resulted in a full removal of the restriction against loop structures. With this in mind, and reading between the lines as to the development of these relaxations or these statements towards the relaxation, it's clear to us, and I think it is to you as well, that Treasury's goal here is to promote the inflow of capital and investment to South Africa. It's rather tried to say that that's typically their goal when they deal with exchange control. This object to bring money into South Africa has been confirmed by the Reserve Bank on a number of occasions, and certainly in its application of our applications to the Reserve Bank, they've reiterated on a number of occasions that they want to see investment into South Africa as a consequence of the loop relaxation. In short, what this means is that where a loop structure is created together with an inflow of funds to South Africa, it will usually be met with warm reception, either by the authorized dealers or by the Reserve Bank. However, if there is no inflow of funds, or if the inflow is not commensurate with the true value of the investment, you'll have a much harder time at the Reserve Bank. It's worth noting that there are certain examples where there isn't going to be an inflow. One of the early loop applications that we did was a transaction between a non-resident proper, which held an investment into South Africa, to a new non-resident, which our client had an interest in. Now, in that situation, the sale of shares agreement was to a non-resident, and therefore clearly no inflow of funds to South Africa. Unfortunately, the bank didn't see it our way, that this was clearly what the loop structure relaxation meant to deal with, and the bank referred the matter up to the Reserve Bank, but at the Reserve Bank it was confirmed that they're happy with these types of transactions. It isn't an abusive process, although there isn't necessarily an inflow into South Africa. In that situation, there was never going to be one in the first place. All right, so we understand where we have come from and why we are looking at a relaxation of loops. Let's look at the current framework, which is dealt with largely by Circular 1 of 2021. Now, it's important to note that Circular 1 of 2021 provided an amendment to the Exchange Control Manual. Again, this is the policy document of the Reserve Bank relating to all matters of exchange control. Now, Regulation 10.1c, however, has not been repealed. Accordingly, Circular 1 of 2021 represents merely a policy change without the underlying legal change. We interpret this to mean a greater emphasis on your application to make sure that you proceed in an authorized manner. In particular, we feel that in order for loop structures to be permitted, although the law doesn't give you the right to create a loop structure, you have the opportunity to apply to the authorities to make sure that it's created in an authorized manner. That application will typically be directly to the authorized dealer. As I said at the outset, it's the authorized dealers who's tasked with the brunt of exchange control administration in South Africa. It is notable, just if we have any deeper discussion on what Circular 1 says and how the manual is currently worded, it's notable that the manual now says that a loop structure only needs to be reported to the authorized dealer on finalization of the transaction. This would seem to be, to me, that you can go ahead and create your loop structure and simply notify the authorities after the fact. That being said, in my discussions with several of the heads of exchange control at the authorized dealers over the last several months, they've indicated to me that the current nature of the applications that they're receiving, in almost all cases, certainly upwards of 80% of the time, involves some sort of complexity that leads to the application being referred to the Reserve Bank. And given that a large number of these applications are being referred to the Reserve Bank, my personal preference is therefore to have all of the regulatory approvals in place before the transaction goes ahead. I think it is good practice to make sure that all of your agreements that create the loop or any cross-border agreements that give rise to exchange control considerations, those agreements should be conditional on the appropriate exchange control approval being obtained. For example, if you're entering into a sale of shares agreement, I would make that sale of shares agreement conditional on the loop structure that results being approved unconditionally by the Reserve Bank. I wouldn't want to get into a situation where you trigger the legal obligations without having any ability to follow through on that. All right, so what should your exchange control application consist of? At the very least, you should provide full details of the parties to the loop structure, these being the resident, the foreign structure, and the inward investment. Again, these three components are the core of your loop structure, and you should place full details of these individuals or entities or companies or trusts on record, who they are, what is their relationship to each other, and how do they operate. In the second instance, you should include documentary evidence that the foreign structure has been funded with authorized assets. In other words, you need to satisfy the authorities that the outward leg of the loop has been done appropriately. In the case of your single discretionary allowance or your foreign investment allowance, this can be a copy of the approval, certainly in the case of the foreign investment allowance, an indication of the proof of the export of funds under your single discretionary allowance would suffice. If you do have foreign assets by way of a foreign inheritance, then you could provide details of the deceased, details of the manner in which you received the funds, whether it's a liquidation and distribution account or a last will and testament or something of those kinds. I think just be pragmatic about what documentary evidence you provide. as long as you can give a strong indication that the foreign assets are authorized, your transaction will be going ahead on strong footing. The next element of your transaction is that you need to provide suitable documentary evidence that the transaction has been concluded on an arm's length basis. Now, when I talk about arm's length basis, I'm talking about the reinvestment into South Africa. So this reinvestment obviously needs to be explained to the authorities. You need to indicate whether it's by way of a loan, whether it's a share purchase agreement, whether it's a share subscription agreement, or whether you've purchased property in South Africa. That detail is useful to give the authorities a sense of how the reinvestment is being made. The arm's length component is crucial. In the current manual, the wording is suitable documentary evidence needs to be provided to show that the transaction is concluded, and here's the important part, on an arm's length basis for fair and market related price. Now, the lawyer in me has a bit of a problem with this because I would assume that if something is a market related, it should also be arm's length. So we should interpret these two terms as having distinct meanings and not just tautologous. There is a strong presumption in our law against tautology. My discussions with some of the authorized dealers around this arm's length requirement are that it doesn't necessarily mean that the parties involved need to be completely independent from each other. And this is a concern that we had right at the outset. Is a loop structure only going to be created between third parties or non-related parties in the correct exchange control parlance? Fortunately for us, arm's length is not interpreted as actually being at arm's length or unrelated to each other. Instead, it means the terms of the agreement need to be arm's length. Now, giving arm's length some meaning distinct from market related, I believe, refers to the price. Arm's length refers to some of the other characteristics of the agreement. If you're talking about a loan, what security has been provided? What is the tenor of the loan? Is it repayable on demand? And are those characteristics of the transaction arm's length? Or would they be similar to what you would expect had the parties in fact been acting independently from one another? And the final component of your application is you should provide confirmation, where appropriate, that there either has been an inflow of funds, or if you're doing this in advance, in a prudent fashion, that there will be an inflow of funds to South Africa. Naturally, when the funds come in, take note of that reference number so you can link it back to the authorized dealer to provide the full circle of the loop. All right, we are now of the view that if you provide to the authorized dealer a properly detailed and fully motivated application, that application goes a long way to ensuring that you achieve the desired result, which is your approval, and that you're entitled to proceed in an authorized manner and make sure that your structure is compliant from exchange control perspective. It is interesting to note, however, that Circular 1 of 2021 expressly operates prospectively. In other words, it does not have the effect of retrospectively authorizing historical loop structures. So when you have a loop structure that was created prior to the 1st of January 2021, and that structure was created in a manner that was not compliant at the time, it is the case that Circular 1 has not regularized your structure. Your structure continues to be unauthorized, and you must take steps to regularize it with the Reserve Bank. At this point, it might be worthwhile that although we now have a wholesale relaxation of the prohibition against loops, this is the last step in a series of minor incremental relaxations over the years. And the position immediately before 1 January 2021 is that South African residents were permitted to obtain up to 40% of the interest in a foreign structure that reinvests back into South Africa. So if your structure was compliant prior to 1 January 2021, then you don't need to worry. It'll continue to be authorized. We're in a more relaxed exchange control regime at the moment. However, if you were over the 40% threshold, or if your loop structure was created before the 40% threshold was put in place, your loop will be unauthorized. And we are of the view, or we're of the understanding rather, that the Reserve Bank has invited people with unauthorized loops to come forward and regularize them for exchange control purposes. In this regard, in our discussions with the Reserve Bank, they've said that they will consider imposing a penalty on the amount of the unauthorized loop, but they will consider the circumstances surrounding the application. What is the nature of the contravention? How did it arise? In particular, the core emphasis is, were assets externalized from South Africa in compliance? These type of factors will be considered, and therefore it's important to provide to the Reserve Bank a fully motivated application setting out the circumstances of the loop. We do feel it's crucial that you make the application before the Reserve Bank initiates any investigation or inquiry into you. The Reserve Bank have repeated time and time again, and this is in line with, for example, the VDP for tax. If you get to the authorities first, your application is regarded as voluntary, and you'll be given a much more lenient dispensation when a penalty is being considered. And if the Reserve Bank find out about your structure first, you're going to be arguing from the back foot, and you might be in a much more difficult situation regarding the penalty discussion. All right, with that in mind, I believe that is a nutshell of the South African exchange control framework that is currently applicable to loop structures. I did promise a description of the South African tax consequences, and these principally attach to the foreign structure. So when you look at your foreign structure, you need to think of a couple of things. First and foremost, what is the nature of any receipts that the foreign structure might become entitled to? Again, this is the capital gains, the rental income, the dividends, the interest income. So that type of income will inform, obviously, the nature of the tax that you're looking at. So the tax consequences are in part the nature of the income, but probably more crucially, the nature of the structure itself. So in the first instance, when we're thinking about the foreign structure, if your structure is a trust, then we need to apply the principles, the tax principles arising from trusts to our analysis of the tax structures of a loop. First and foremost, because your trust is a non-resident, we have to think about the tax laws in the jurisdiction in which the trust is a tax resident. Now, at this point, it might be worth emphasizing that it is crucial, if you are dealing with a foreign trust, to ensure that that trust is properly regarded as a tax resident of a foreign company, a foreign country rather, and rather than a tax resident in South Africa. It is quite easy to shift the place of effective management to South Africa, and although the trust might be registered offshore, it might be regarded as a tax resident. So just have a look out for that. Make sure that it's tax resident where you think it is, and apply the foreign taxes of the appropriate jurisdiction. The second tax component to think about is the applicable double tax agreement between South Africa and the foreign jurisdiction in which the trust is tax resident. Very importantly, have a look at the attribution rules for income tax purposes. This is contained in section 7.8 of the Income Tax Act, and there are the corresponding paragraphs of the 8th schedule which deal with attribution of capital gains. Next, very, very topical at the moment, whenever you're dealing with trusts, local or foreign, section 7C will rear its head. Be aware of the deemed donation rules. Just be aware that 7C has been extended every single year over the last 4 years, and it can sometimes creep into situations where you're not necessarily expecting it. If a trust is involved, read section 7C. Obviously, when trusts are involved, you also have to look at the conduit principle. For the most part, depending on how you interpret this, section 25B provides a codification of the conduit principle. And as I said earlier on in the presentation, be aware that 25B has been amended to take care of loop structures where the participation exemption would have otherwise applied. The participation exemption no longer applies to reinvestments into South Africa. And finally, when you're looking at any cross-border transactions, those involving foreign trusts especially, you have to look at the transfer pricing rules, and those are contained in section 31 of the Income Tax Act. All right, so if you have a foreign trust, these are the considerations. Alternatively, if you have a foreign company, one should consider the following tax consequences. Similarly, the foreign tax, this time of the jurisdiction in which the company is a tax resident. Again, please be aware of the place of effective management. It's very tempting for South Africans to take the driving seat of their foreign companies, and that might risk the company being regarded as tax resident in South Africa, notwithstanding the fact that it might be registered offshore. Again, the double tax agreement, the treaty between South Africa and any foreign jurisdiction, is a core aspect of any tax transactions. When you're dealing with foreign companies, the CFC, or the controlled foreign company rules, almost always come into consideration. These are contained in Section 9D of the Income Tax Act. Just remember, when dealing with 9D, there are a lot of exceptions. If you want to think about the foreign business establishment principle, there's the high tax jurisdiction exemption. It can get quite complicated, so look at your controlled foreign companies quite closely, especially if South Africans have an interest in more than 50% of the shares. And finally, again, with any cross-border transaction, transfer pricing is going to be a consideration. Again, look at Section 31 of the Income Tax Act. So that's the situation if you're dealing with trusts and companies. If you're dealing with a combination of the two, it makes it very easy. You need to think about everything. Foreign taxes, double tax agreements, CFC rules, attribution of income, conduits, and transfer pricing. These foreign structures that involve both trusts and companies are very interesting, but can be quite complicated from a South African tax perspective. That being said, it's important to emphasize that this is just an overview of some of the key tax considerations. Tax, I'm sure you, as I'm sure you'll be aware, has a very interesting way of becoming quite complicated quite quickly, and nuances into the tax calculation have a habit of creeping into the mix, and that's especially the case with loop structures. All right, so let's wrap up by looking at the benefits of creating a loop structure. Why would you want to do this? Why would you go through the headache of doing a reinvestment into South Africa? Now, in the first instance, having a loop structure in place provides an excellent opportunity to consolidate your global estate plan. In the context of having interests in local assets and foreign assets, especially where those interests are housed in a variety of different trusts for different mechanisms, it's now possible to consolidate your investments and hold everything through a single structure situated offshore. This might certainly reduce the need for a South African trust and reduce the need to go to the South Africa's Master's Office, because as you know, that is always a difficult endeavor at the best of times. And so by thinking about your global estate plan in the context of being able to make investments into South Africa from offshore, it can clean up the structure, it can reduce unnecessary administrative burdens and cost burdens, and it also can give you an opportunity to think about your structures and your estate plan holistically, where having disparate pots of interests can make it quite complicated. Okay, in the second instance, having a loop structure in place allows you to take advantage of investment opportunities that you might find in South Africa, but with assets that have already been externalized to the foreign structure. In particular, some of the sectors of society and one or two of our clients are quite bearish about the future of South Africa's exchange control regulations. And if you are bearish about exchange controls, it's obviously prudent to try and externalize your assets while the going is good. And so for these clients of ours who believe that there might be opportunities to externalize, now being able to reinvest from a structure that's situated offshore is a neat compromise between having foreign assets while maintaining good interests in South Africa, or rather interests into good investments situated in South Africa. We, however, are of the view that South Africa is on a liberalization trajectory for exchange control. So we hope that exchange control will continue to get more and more relaxed, but we'll have to see. This is an ongoing chapter in South Africa's legislative developments. Finally, there are some global tax efficiencies that can be gained by appropriately organizing one's affairs. However, as always, beware, never enter into a transaction solely or mainly for the purposes of tax, as this would certainly fall foul of South Africa's general anti-avoidance rules. In addition, have a close look at the wording of the double tax treaties. Some of our treaties with foreign jurisdictions incorporate wording that has a very similar effect to the general anti-avoidance rules. In other words, if a transaction has been entered into for the purpose of taking advantage of a treaty provision, you might find that that treaty provision is rendered inoperative. And so while tax planning is certainly a key component of this, and we are of the view that there are some tax efficiencies to be gained, that shouldn't be the primary driver behind making this a reinvestment. Overall, we're of the view that loop structures are, well, the new loop regime is an excellent regime. We're strong proponents of utilizing it and entering into loop structures where appropriate. However, that being said, it is not a panacea. It does not provide a solution to every single situation. And as always, you should enter into structures like this with the appropriate forethought and the appropriate professional advice taken in advance. With that, thank you very much for your attention. I believe that this is a broad overview of the regulatory environment relating to loop structures. And thank you very much for your time and attention today. I will now hand you over to Anthony Chait, who I believe is monitoring the Q&A and the chat for your questions, and hopefully we can deal with those as best we can. Thank you.
Thank you, David. And what a really interesting presentation. And I think we can now see why when you went with your very first one in January, you got it over the line so quickly, because clearly you have a great insight and knowledge into the subject. We are taking questions. We have had a few during the course of the presentation, but to the extent that you have any at this point in time, please feel free to post them in the Q&A. So I'm going to deal with two questions. There's actually a third as well. Very good questions, in fact. So David, the first question, and I think this relates to one of the points you made early on, where you explained resident and non-resident. And so pursuant to that is the question, in the context of loop structures, certain resident does not mean or involve being a resident for tax purposes. Would you like to comment on that question?
Yeah, it's a very good question. I do think that Robert Verkale will give a lot more context to residents, non-residents, broadly speaking, next week. So I don't want to steal too much of the thunder from that presentation, but for the purposes of loop structures, dealing with the old regime, firstly, up until 1 March, you changed your residency status for loop purposes, or for exchange control purposes more generally, by doing an application, a formal immigration, and being regarded as a non-resident that way. Now, it's interesting because you were able to backdate your immigration to the date in which you left South Africa. So by doing that formal process, you were able to change your residency status to a non-resident, and thereby reinvest back into South Africa more like a non-resident proper than a South African resident. The current regime, unfortunately, is a little bit opaque. My interpretation of it is this. If you did formalize your immigration prior to 1 March this year, for exchange control purposes and for loop purposes, you can go ahead and do a reinvestment without creating a loop structure. You are regarded as a non-resident for exchange control purposes. This is provided, of course, that you haven't re-entered South Africa and re-immigrated and become a South African resident again. If you didn't make use of the prior system of exchange control immigration, in other words, you didn't formally financially immigrate, I would then regard you as a resident or non-resident with your tax resident status. So only when you cease to be a South African tax resident will you then fall outside of the South African loop structure. More and more exchange control and tax are being linked up. And I think in the future, the exchange control question of resident is going to fall away entirely, and instead be replaced simply with the question of tax residence. You might be aware that for certain purposes, you need to have shown that you're tax resident for 3 years. This is, for example, disinvesting from retirement annuities. But for loop structures, my view is that the day you cease to be tax residents, look at your ordinary residence and your physical presence tests, look at the treaty. The minute you cease your tax residence, you then fall outside of the loop structure.
Thank you, David. The next question is also a good one, interesting one, and In fact, for me, let me pose the question and then we can deal with it. But it seems to be part of the previous regime where, whilst loops were outlawed, this was considered a so-called unintended loop, and in my experience was actually condoned by the Reserve Bank prior to the dispensation from 1 January. So the question is quite simply, what is the situation where a SA resident acquires a minority interest in a foreign entity which pools funds for reinvestment, and some of those are South African investments? David, your thoughts on that?
Yeah, I think you're exactly on the right track, Anthony. There are two types of relaxation that we should be aware of prior to 1 January 2021. The first one is the thresholds. I'm trying to remember, it's been a while, and fortunately we don't have to worry about it too much now, but prior to the 40% threshold, there was a lower percentage threshold. Do you remember, Anthony? Was it
20%? I think it was about 20%, yeah. I seem to remember.
So obviously, provided your outward leg, the resident to foreign structure leg, doesn't cross that threshold, then as a matter of principle, you're on the right side of the loop structure. The reinvestment leg, I think that's where the unintended leg comes in. And certainly there has been if not a well-communicated policy, a well-established policy of the Reserve Bank to condone unintentional loop structures. If, for example, your fund manager offshore says that we're going to invest largely in these foreign companies, but we still think that a South African listed investment provides an excellent potential return on investment. If that's part of their overall global investment strategy, then the inward investment is unintentional. It's not designed to get around regulation 10.1c and provide a mechanism to externalize growth. It's part of a general strategy. And in that case, those structures were authorized. We perhaps quite cautiously have always sought to place these structures on record with the Reserve Bank and make sure that at the outset, the Reserve Bank gives us the approval on the basis that it was unintended, or it wasn't there to contrive a way around 10.1c.
Great. So the final question, unless there are more, and we do have some time, so feel free to post them if you have any. This question relates to probably one of your last slides where you went into the why, and you explained the rationale or the incentives for entering into or creating loop structures. And your second one was the externalization of South African assets. Now, if that asset is an intangible in the form of, say, intellectual property, David, what are your thoughts of using a loop structure where there is intellectual property or IP that clearly vests in South Africa? Would a loop structure be a possible way of externalizing that IP?
Yeah, thanks, Ant. It's a very, very interesting question, and it involves a lot of exchange control considerations. So I'm happy to go through some of those aspects with the audience now. The externalization of IP, I think, is probably easiest illustrated with something that you create. Let's take copyright, for example. If you are the author of a book, where did you generate that intellectual property? If you wrote it exclusively on your holiday in the Maldives, then you generated that intellectual property outside of South Africa. And I think it'll initially be brought into existence without South African problems associated to it. However, if you wrote the book in South Africa, you as a South African resident generated that intellectual property here, and you've now got a certain asset which attaches to you, it's part of your estate in South Africa. Should you wish to externalize that intellectual property, it's possible to send it out of South Africa by way of either a sale and enter into an arrangement with a foreign entity, for example, a foreign company that might want to buy your intellectual property from you. Alternatively, it's possible to license the intellectual property. I won't deal with licensing now because ultimately the the intellectual property will remain in South Africa. So that doesn't trigger any loop problems. So in the event that you want to sell your intellectual property to a foreign structure, and in particular, if it's a foreign structure that you have an interest in, let's say you're the shareholder in the foreign company. We're busy working with several of these applications at the moment. And so in our discussions with the Reserve Bank, they've indicated to us that they will look favorably on these applications, provided a couple of things are in place. Firstly, the general loop provisions apply. So when I dealt with all of the requirements for the establishment of a loop, making sure that you have authorized foreign assets, making sure that you give full details, all of that goes without saying. In the case of intellectual property in particular, the three areas that are particularly necessary to look at are, firstly, the sale proceeds needs to be sitting offshore, authorized, and needs to come back into South Africa. That introduction of funds is absolutely crucial because that's the purchase consideration. Provided you're prepared to do that, the Reserve Bank will then be interested in your motivation for why you're selling this asset out of South Africa. Obviously, South Africa is then going to get a capital introduction, but that's the last they'll see of this asset. And so the Reserve Bank wants you to motivate two things. Firstly, that the intellectual property is better assigned or sold rather than licensed. They want to see the reason why you are selling it. And secondly, they want to understand the benefits to South Africa. For example, if your book relates to mountain climbing in the Himalaya, obviously I think the audience will largely be people outside of South Africa, and you might be able to argue that you'll better be able to capture that audience by situating the intellectual property around the book closer to or in a jurisdiction familiar to your audience. If your intellectual property relates only to something in South Africa, I think you're going to have a hard time persuading the Reserve Bank that there are going to be benefits to South Africa to having the intellectual property situated offshore. Always, when you're dealing with cross-border transactions, particularly between related parties, you and your company you have a common interest, or you have an interest in your foreign company, it's imperative that you show that the transaction is entered into on an arm's length basis and fair and market-related rates have been determined and applied.
Thank you. There's been one further question, also an interesting one, and so let's just deal with it. And the question is, can one create an offshore company that simply owns a CC in which the assets are shares in a South African company that in turn owns a UK company and also owns a local property? So we're drawing pictures in our mind here. The question then goes on to ask, then on the sale of the offshore business, can the process continue in the new business or trust created for the above purpose? Would a trust also be able to work for that? So a couple of links to that. Hope you've grasped it, David, your views on that.
I think so. Any exchange or question starts with drawing that horizontal line. If I understand correctly, you've got a South African resident, an interest in a foreign company. That foreign company has an interest back into a South African structure. Whether the structure has a CC or a PTY Limited or various underlying companies doesn't matter too much. The South African structure owns in turn a foreign structure, which in turn owns property back into South Africa. The way I see it, you've got two different loop applications. Each inward leg needs to be motivated. There needs to be an inflow of funds. And importantly, as I said at the time in my presentation, that inward investment you need to show that it's been done at arm's length of market-related values. But I don't see necessarily anything that would provide an impediment to the structure. If you look at the manual, it's worded in very broad terms. In other words, it's almost a right, although, as I said, 10.1c still exists, so I won't go so far as to say you have a right to create a loop structure, but most structures will be permitted provided you take the steps to properly place on record the various components of the loop structure. And in this situation, rather than doing two separate applications, which might have the propensity to disguise the whole structure, I would do a single application to the Reserve Bank motivating for the entire structure to be placed on record. if, just dealing with the last component, if you do place a trust into the structure, usually the trust takes the role of the final holder of the various assets. And so the Reserve Bank are interested in the warm bodies behind the trust, in particular, who funded the trust, who's the settlor or the founder, and more importantly, who are the beneficiaries of that trust. And if a foreign trust has South African resident beneficiaries, the Reserve Bank is interested in what that trust owns, particularly if that trust has an interest, even if it's an indirect interest through various offshore entities into South Africa. So I guess it's a long way of saying it's probably going to be authorized. It would be important to make sure that you look at the entire structure holistically. What are you trying to achieve? Is there anything that the Reserve Bank will be concerned about as subverting 10(1)(c)? And if you're not doing that, then the Reserve Bank would almost certainly approve it.
I just had a comment because the person posing the question speaks about using a CC, which the offshore company holds what would be the member's interest. And I'm not sure in terms of the Close Corporations Act, which has been around for nearly 40 years, coming in 1984, whether a CC, a member of a CC, has to be an individual. But my comment there would be then just replace that CC with just an ordinary PTY, and that would do the trick. Get another question, which is interesting, and I'll deal with it quickly. It's a simple question. Are loop structures only applicable to unlisted investments? So if you have if you're a substantial shareholder in a listed company, perhaps you were one of the initial promoters or vendors of that business and did an IPO, the question is it only limited to unlisted, or could you, in that example that I've just given, also create a loop structure?
Yeah, the short answer is no. There's no limitation as to whether it's listed or unlisted. You can acquire listed shares through an offshore structure. The same principles apply whether it's listed or unlisted. Obviously, with the advantage of acquiring listed shares being that your ability to show the market-related price is quite a lot easier. And you just look to the quoted price on the date. With that in mind, one area that I think I was possibly anticipating questions on, but we haven't received any, it would seem, is what would need to be shown as, quote, suitable documentary evidence for the market value. For quoted shares, definitely the market value is published on the date. For unquoted shares, you would need to get something more formal. The manual refers to an auditor's valuation. I don't think you need to always use an auditor. There are circumstances where it would be appropriate to get a different type of valuation. In the case of fixed property, for example, you could find an estate agent who could do a comparative analysis of sales in the area of different similarly situated properties, and that should be accepted as adequate, suitable documentary evidence. In the case of other assets, for example, a sworn valuation would suffice. And if you're taking up shares by way of subscription, if you indicate to the authorities, be it the authorized dealer or the Reserve Bank, that the company has just been freshly incorporated, in that situation, I wouldn't say that you need to get an auditor's letter. You can just provide suitable indications, the SIPC documents, to show that you're the first shareholder and you're taking up your shares for your 100 Rand.
Great. David's calling card is on the screen, and we do endeavor, even after the seminar, to provide answers to all questions that are put to us. So feel free to email David at the address that is up now, and it will be our pleasure to provide answers. David, thank you. It was a very complicated topic, but well presented. And we will see you again next week when Robert will take the podium. But for today, thank you for your attendance. I hand you back to Stan.
Thank you very much, David. Very interesting. I'm sure a lot of food for thought, certainly for me and for others. Anthony, thank you for staying up past midnight. and participating, and your input is always valuable. Everybody who registered for this and is paid will get their certificates in the next couple of days. David, once again, thank you. Well prepared and well presented. Danny, thanks for doing all the technical stuff and behind the scenes work, and everybody else. So we were due to finish a little bit later. We'll still give you the credit for the CPD points. Don't worry, unless you want to stay on the line until 4 o'clock, but it's not necessary. So thanks very much again, and you can have the rest of the day off. David, you too. Good night. Closing off now.